My name is Kieran, co-founder of Swoop. That's what we do with Swoop is help businesses access funding solutions. Of course, a lot of the funding things we'll be talking about today. I personally have raised 25 million for Swoop with both lending, equity, and grants. So we can chat about that. But equally, we've about 300,000 businesses on Swoop and who've received lots of different funding. So again, I can chat into some of the trends, but really, really excited to be here, and hopefully we can add a bit of value back to yourselves. Sam?
Great stuff. Yeah, it's great to be here again, Kieran. Every time you say you remind me you've raised 25 million swoop, I want to take my invisible cap off. That's huge. So, hello everybody. I'm Sam Simpson. I'm one of the co-founders at Founder Catalyst. I'm an exited founder myself, so I grew a tech company 0 to 30 million in 4 years and exited to private equity, which was amazing. I'm an angel investor as well. So over the last 8 years, I've got 35 investments, about £1 million deployed. And during that process, I kept bumping into loads of founders who had really great ideas, who knew they needed funding to achieve their dreams and just didn't know where to go. And I had an itch to scratch. I wanted to learn. I'm kind of an all or nothing person. I wanted to know everything I could about equity funding. So I thought, wouldn't it be great to build a company that does exactly that? Which is probably the weirdest reason for starting a company. So I'm known as Mr. SEIS or Mr. Equity, which is great, which is why I love presenting with Kieran, who knows a whole bunch of stuff about a whole bunch of stuff I don't really know. So hopefully I can take you on a journey on the equity side. And yeah, Kieran's going to fill in all of the other sources of funding, which I think is great. And Kieran, if you don't mind, I'm going to go off piece for a minute and explain from
Please
my
do.
perspective why I think this session is absolutely vitally important. I do lots of webinars. I think this one is absolutely crucial because equity funding is in a bit of trouble at the moment. It's not quite as great as it has been. If I give you some insights, which are from Bowhurst, who track every single funding round in the UK, they've released some stats literally last week in what they call the Deal 2026, which is their summary of last year. And there are some really, really glaring statistics that stick out. So, average pre-money valuation, for example, has dropped in 2025 back to 2021 levels. So it peaked and it's dropped back down, from 5 years ago. And you may go, yeah, that's not too bad. But if you look at all of the other changes that have happened in the last 5 years, wages are sky high, national insurance is increasing, cost of living crisis, all of those things. It kind of puts that drop in context. The number of seed rounds closed in 2025 dropped 65% when compared with 2021. 2025 Q4 versus 2021 Q4 shows a 45% drop in pounds, shillings, and pence invested into companies. And unless you are in AI or deep tech, investors are specifically looking for traction right now. So the old trick of I've got a shiny pitch deck and a bright idea, will you invest in me? Those days have really gone, unless you're in AI and some deep tech. So what does that mean for fundraising in 2026? In short, it means it's harder than it's ever been since I've been an angel investor since 2017. And I think what that does mean is if you're looking at funding, it probably won't be any one of these sources. It won't just be equity at the moment, or you'll be lucky if it is. It won't just be debt. I think the smart founders are going for a combination, as Kieran had, of some equity augmented by grants, augmented by debt, and squeezing the daylights out of R&D tax credits. So I think of all of the webinars I do, I think this one hits hardest.
Super. Yeah, definitely echo about your sentiments and what Bohurst is saying, which again, just re-emphasize the point, hopefully just showing you the full breadth of options, and will leave people with some ideas about what possible routes would suit them and their businesses. Um, so I suppose just kind of kicking that off, as I said, we're going to go through all these. As ever, we love to be interactive. So if questions do crop up, put them in the chat. We'll jump on them straight away, and obviously leave time at the end as well to go through as many of your questions as we can. Ultimately, let's go through them and start with debt financing. So again, don't want to come across as sucking eggs, but I suppose this is one of the most kind of well-known ways of raising finance. But actually, when we peel under the hood, there's so many different lending products that you can consider as a business owner. But typically speaking, the reason why many business owners will go down the debt funding route is it allows you to keep that complete ownership of your business. So unlike equity where you're giving a percentage of your business away for that injection of capital. With debt funding, you're keeping control of the business, but crucially, though, you're going to have to repay that money in terms of the capital plus interest. So really understanding affordability and cash in, cash out is super important when considering debt finance. And one thing I would always encourage business owners, even if they're not from an accounting or an economic background, is really to get into forecasting and really get familiar of the ins and the outs of your business before looking at any kind of debt instruments so that you're pretty confident of what's coming in and out of the business from a cash in, cash out perspective. So that when you do look at debt, it becomes easier to understand if I have a certain line item of extra cash coming out on a monthly basis, have I got the overhead? Have I got the capacity to take that on? Um, but just digging into kind of lending at the top end, traditionally we would have always associated going to your bank, your HSBC, Lloyds, HSB, Barclays, NatWest, and having that relationship with the bank manager and them giving you kind of a yes or no on whether they can give you an overdraft, give you a term loan. But what's happened since, say, the global financial crisis in 2008 is we've had a plethora of alternative lenders in the UK. So like if you're to come on to say something like Swoop and look at a term loan, you're potentially looking at 100, 150 different providers on the market. So what's happened as those bigger banks started to look to give less and less to SMEs in particular or new businesses, a new wave of different providers or alternative lenders have come in to the market to offer alternative credit sources. So where many business owners are getting a lot of rejection from banks, there are a lot of sources out there, and often where they try and compete with the banks are around things like speed and flexibility. Like many business owners that come into to Swoop, a lot of them need cash within a quick period of time, and often this is where alternative lenders can add value. Traditionally, what we've seen in the market is these alternative lenders will price a little bit more expensive than your high street banks. But what I would say, particularly over the last 12 months with a declining base rate, the base rate's currently at 3.75%. We've actually seen some of these alternative lenders starting to price really competitively, where we're getting down into around 7, 8% for the kind of A-graded businesses, which is not something that I've seen since pre-COVID levels. So a lot of these big alternative lenders are now starting to compete more and more on price with big banks, but have the added benefit of kind of quicker turnaround times compared to the banks. The other thing I would say, just actually before digging into some of these specific debt products, is some of you may be familiar with the growth guarantee scheme. That's become really, really popular both with banks and alternative lenders. And the reason that's interesting is it allows both banks and alternative lenders to increase their credit appetite outside of where their credit models would traditionally look at. So it means that they're giving out a bit more lending because what the government is saying is they will guarantee a portion of the loan book that bank or alternative lender is going out. What it also allows the bank or alternative lender to do is look at the security slightly differently. So one of the impediments or barriers we see from business owners looking to take on lending is they often have to give a personal guarantee. With the growth guarantee scheme, often that personal guarantee is reduced, sometimes in the case of 20 or 30% of whatever the capital allowance is due back. So it reduces that exposure down, which is why we see a lot of popularity in the growth guarantee scheme. So something kind of to be aware of that's quite popular, but a lot of the bank and alternative lenders are finishing up their growth guarantee scheme at the end of March. So something to be aware of if business owners are looking at the GGS. Now, I've kind of basically been talking in terms of vanilla there, in terms of term loan. I take £100,000, I pay it back over a 60-month period, and I have a certain rate that I pay it back. But actually, when we look at SME financing today and over the last 5 or 6 years in the United Kingdom, there are so many different types of instruments that businesses are using outside of your traditional term loan. So what I'll quickly do here is just introduce a few different concepts, and if anything resonates now or later, please feel free to reach out. One thing we see for early stage businesses when they're looking for debt financing and they do want debt financing, if they don't have two sets of filed accounts, they haven't been operating for say more than 2.5 years, a lot of traditional banks and lenders will automatically reject them because of the age of the business. So they're not really able to get those traditional term loans. One route in we see is a way to get early stage capital into business, even if the business is relatively new, 3 months, 4 months, 5 months old, is a thing called selective invoice finance. So to give you a kind of a tangible example, you might be a new food business and you're up and trading, and one of your routes to market is you're now stocked in Tesco. And Tesco put in a significant order for business, which is fantastic. But Tesco pay you on 90-day terms. You have to wait 90 days to get paid. What you can do using selective invoice finance is take that invoice that you've raised with Tesco, bring it to an invoice provider, and get about 90% of that cash fast forwarded into your account there and then. So then you can put that cash to work within it. The lender will then recoup the full 100% from Tesco, and then they'll make their 10% margin that way. What we also saw post global financial crisis was a lot of the banks removing the overdraft facility from small businesses, because for every overdraft facility, they need to put that on their balance sheet, which meant that they were reduced from being able to potentially capitalize more profitable opportunities, bigger loans at mid-market firms. So we've seen a real reduction in overdraft capability. And essentially what's arrived on the scene is a lot of revolving credit facilities, which work very similar to an overdraft, but often given by alternative finance providers, where they're able to look at the business, extend a line of credit that businesses can flexibly use as and when they need it. Think of it like a rainy day fund. Then we've seen a real rise in revenue-based finance. And traditionally, we would have seen this in the leisure and hospitality industries, where you have a lot of point-of-sale income, and lenders were using that data to advance sums of money. And then through COVID, we saw a real rise in e-commerce. And again, it's the same methodology where you're taking something like your Shopify data, looking at the average amount going through Shopify, and then advancing that sum to the business, and the business is then paying that from future future earnings. Yeah, I just see a comment, I suppose, there from David to say he's delighted to see invoice included in the presentation. And I'd echo the sentiments. I suppose I only just briefly mentioned selective invoice finance, but I can see David from a brilliant company called Bibby, which offer a huge amount of flexibility, not just from a selective invoice finance perspective, but we'll also be able to look at the whole of book. So again, trying to give it a tangible example here, but if you think of the recruitment industry, they might be placing people into businesses either on a temporary or on a part-time basis, and there's a lot of activity going through their books. And again, trying to manage things across different payment periods might make sense to just work with one invoice finance provider that can help you have kind of smooth cash flow through your business. So yeah, just a couple of different examples there on the short-term side of things. Again, sorry, I'll move a bit more quickly. Security-based options. So you might be a relatively new business, but you're interested in purchasing assets. This is something to consider when looking at cash flow. You may not want to purchase all of those cars. You might want to lease that cars. It might help you from a cash flow perspective. Although another kind of flip way of looking at that, you might have significant amount of machinery on your balance sheet. You can release equity from that machinery again for funding. The same is true for property, and the same is true, as we've touched on, for invoices. So outside of kind of the traditional, how much profit am I making, what the EBITDA margins are that we talked about in traditional term lending, there are lots of other ways to think of releasing funds into a business. And again, looking at the balance sheet, whether there's significant assets on the balance sheet from stock, from debtors, or from property, these are ways to release funds back into the business. Uh, and finally, just traditionally, what we would say with the asset-based products and asset-based lending, that's where you'll tend to have your lowest rates compared to your short-term lending, which is where you'd have your more expensive rates. So yeah, I'll just pause there on all things lending and pass the baton on to Sam on the equity side.
That was a great, as always, a great sheep dip into the world of debts and loans. So appreciate that. I'm going to rattle through these slides. Both Kira and I share a passion for answering questions rather than talking at people. So I'm going to rattle through these really quickly. I'm going to talk about equity options within the UK. Broadly, I should introduce what equity means, what I mean by an equity or a funding round. It's broadly just selling shares in your company. So unlike when you have debt or lending, you're borrowing some money, you need to pay it back plus interest or whatever. Equity funding is about having shares in your business, selling more shares, so you always allot more shares. People own the shares until you exit, or there's a secondary sale or whatever. But people are expecting to put £1,000 into your business, and they're buying the shares at £10 each, and maybe the shares go to £100 each. They get a 10 times return on their money, and they are very happy. Within the UK, you have a superpower, and that is called SEIS and EIS. Those are tax relief schemes run by the government. There's no point dancing around this one. If you're offering SEIS and EIS in the UK, your business may well be attractive, and if you're not, it probably won't be to UK angels at least. So it is genuinely your superpower. On this diagram, we bring to life the different equity options within the UK. I've actually got a later version of this. I managed to forget family offices, but family offices are a quirky part of the ecosystem. They're really tightly gate kept. They're really hard to get hold of, but they can maybe make use of SEIS, EIS as well. They can be a bit more flexible than some angels. Broadly in the UK, the people that can make use of SEIS, EIS, which I'm going to introduce properly in a minute, but broadly, your family and friends might be able to make use of SEIS, EIS with some caveats. Angels will absolutely, UK-based angels will want it. I've got 35 investments. Every single one is under SEIS, EIS. I don't even look at anything that isn't. That's how important it is. Angel networks, SEIS fund, crowd funders like Crowdcube and Republic, as it's called now, or Cedars as was, and so on and so on. When you get past the SEIS and EIS funds, you come to strategic investors, which is basically other companies investing in your business. They won't make use of SEIS, EIS at all. And then you get to VCs, and they certainly won't make use of SEIS or EIS either. But if you're doing your pre-seed or seed funding round, you'll probably want to be talking to people between friends and family and up to SEIS funds, and therefore SEIS, EIS is going to be vital. If you wouldn't mind skipping to the next slide, and I'll do an introduction on the really amazing tax breaks of SEIS, EIS, and explain why they're amazing. There are two schemes we're talking about here. We're talking about SEIS, or Seed Enterprise Investment Scheme, and EIS, the big sister, which is Enterprise Investment Scheme. SEIS is meant for maximum risk, early stage, and gives really, really punchy tax breaks. EIS is good, but not quite as great. So the tax breaks aren't as good, but you can raise much more over a much longer period. So under SEIS, let's cover this one first in detail. You can raise up to 250k. You can raise that for the first 3 years from the date you start trading. Once you run out of those two, one or the other, you then move on to EIS typically. I'll give you an example of why SEIS is so amazing. I'm going to put £10,000 into your business. Almost instantly, the government's going to give you £5,000 back, the investor back £5,000 as an upfront tax relief. If the company fails, then the government will give you back another 22% or £2,200, meaning that I'm only ever risking 28% of my money when I invest in your business. If the business does really, really, really well, so you manage to turn my £10,000 into £1 million, that's a very good investment. But if that happens, there's no capital gains tax at all to pay. CGT is being ramped up by the Labour government. It's gone from 20 to 24%, and it will keep increasing, I suspect. But you don't pay a penny, so you are saving yourself and as an investor something like just shy of £240,000, which is lovely. If the business fails for whatever reason, no, sorry, we've covered that. If I die, so if I invest in your business, I hold the shares for at least 2 years, and I die, which is a less cheery outcome, then the shares will pass to my estate outside of inheritance tax calculation, subject to a 1 million lifetime limit. So those are the tax benefits, just absolutely amazing. EIS, let me run through that. The upfront tax relief is 30% rather than 50%. So it's good, but not great. The loss relief is less as well. So I'm risking 38% rather than 28% of my money. The capital gains tax and inheritance tax exemptions are identical. Under EIS, though, you can raise up to 12 million in total, 5 million per year over 7 years. These numbers are doubling. So as of the 6th of April, you can raise up to 24, up to 10 million a year. The 7 years doesn't change at all. So those numbers are changing as of the 6th of April. So those are the tax relief schemes, absolutely amazing. And you can understand why UK angels, firstly, why they don't consider foreign companies, because those typically don't come with SEIS, EIS. Therefore, it makes your UK company really, really interesting. But you could also see why, if you're not offering these tax breaks, then people typically won't be interested in you. Your only way of proving to investors that you are eligible under the scheme is something called advance assurance, and that's one of the services that Founder Catalyst offer. So we help you prep for a funding round by getting SEIS, EIS advance assurance. We do all of your funding legals. And then we help with some of the pesky SEIS, EIS paperwork at the back end as well. And that's all for a fixed fee of £1,500, irrespective of how much you raise. There's just one other thing I wanted to cover. If we can skip to the next slide, please. And
Yeah,
that
just to,
is,
I think you kind of answered there, but just with one question that came in for you there, Sam, from
okay.
Derek, it was just to say, um, I think it's more just reiterating what you just said, but just to completely cover it up. Are you able to consult help with SEIS structuring too? He's an engineer rather than an accountant, so understands the maths, but finessing the solution outside of his, yeah, just double checking.
Absolutely. Yeah,
Yeah,
we'll share our contact
yeah.
details after this. Derek, I'd love a chat. I'm a chartered engineer myself, so I feel your pain. I come from a engineering and computer science background. But yeah, we'll help you to the extent possible, preen your business so it stands every chance of firstly getting SEIS, EIS advance assurance, and secondly, impressing your investors. So that will be good. Um, in terms of how you approach investors, so you need to get your ducks in a row before you start any outreach to investors. Otherwise, you'll just look ill prepared for a funding round. For me as an angel, I think there are 5 things that I want to see. If these are confusing to anybody, chuck them in the chat and we can deep dive. But the first one's hopefully straightforward. You need a pitch deck. You need to bring to life what problem you're solving, what is your solution, what does the market look like, what you've done so far, who the team is, and what you're asking for broadly. You need to answer all of those things and a few other bits and bobs. Um, you need a financial model, so you need a forecast for at least 3 years. And ideally, you'll extend that until the point you're profitable. There's no point stopping a forecast at year 3 if you're still loss making. That's not going to look compelling. The third thing you need is SEIS, EIS advance assurance that I mentioned. So that is your only way of proving you can offer the tax breaks to your investor. The fourth is a term sheet, and a term sheet is a summary of your legal offer to your investors. It summarizes, how much you're looking to take on investment, what your valuation is, what legal entity it is, what rights and protections you're offering your investors, and you can download a customized free term sheet from Founder Catalyst by creating a free account. The fifth and final, back in the halcyon days of 2021, this wasn't required. It very much is now. Is a valuation justification. So coming up with an answer to, you're going to value your business. The average pre-seed, pre-revenue valuation is 1.5 million. Not if you're AI. If you're going much higher than that, you're going to have to justify why you're doing that. So those are my 5 must-haves. I think on the next slide, we're going to look into debt versus equity. And Kieran and I are going to get boxing gloves on. Go on, you start on the debt side then, Kieran.
Yeah. Well, I also noticed I missed one other question just on the end of the lending. We had a question in terms of are you able to kind of mix the lending mixes together? Like, is it plausible? In this case, the business is effectively a SaaS business with 12-month minimum contracts, B2B business. So, yes, there's definitely ways you can look at different lending instruments that will complement each other. Potentially, there's one, say, long-standing invoice that you might want to raise finance on, But you might use other instruments alongside that. So, give you an example of ones that we're seeing quite popular at the moment. With kind of SaaS or e-commerce businesses that may have had a bumper, let's say last quarter, in terms of they had a lot of trading volume going through from, say, Christmas sales, Black Friday sales. The knock-on effect from that might be they have a larger than expected VAT bill, say for this quarter. And instead of maybe paying it in one go, you can spread the cost of that over a 3 month period because that's going to help your cash flow. Complementary to that, you might also decide to run your invoice book or invoices through invoice finance. So yeah, certain instruments can be used side by side. Similarly, that same business might be looking to invest in more machinery or more vehicles, and actually doing that in a leasing methodology allows them to be able to again do it in a better cash management way. So yeah, lots of instruments can be used in a side by side capacity. You don't have to think that as just one instrument and one instrument only. So yeah, then just touching on the kind of debt versus equity mix, I suppose I spoke a little bit about the beginning is one of the big drivers for why business owners may go down that debt route is complete uh, staying fully controlled in the ownership. So to take Sam's example at the beginning when he was building up his own business and was able to realize the exit, I think it's fair to say one of the big benefits there was you had 100% of your business in that scenario, whereas one of maybe the downsides, but if I was fortunate enough to have a exit a thing in the future from a street perspective, I wouldn't be getting 100% because we've taken equity investment along the way. So there are things I suppose you need to be able to think about. One big thing is speed and time. So for anyone that has gone down equity raising journeys, something to be super cognizant of. It's very hard to control the exact timing of it. I suppose one of the added benefits, and Sam can talk into it about SEIS, CIS is it's linked to tax years, which is no bad thing because where with debt, it's quite formulaic. If you have the asset or you have the cash flow and you can see it within the numbers, then you're going to be able to get a yes or no from that bank or lender in a matter of hours or days, which means that if you do want to realize that opportunity, you can get the cash in your bank in a very known finite amount of time. Whereas with equity, it's slightly different when it comes to those timelines. The other really, really important thing, though, to think about it of with debt as opposed to the equity side is really that cash in, cash out element. Because with debt, yes, you're getting that influx of cash, but that needs to be paid back plus some. So it's really, really important that, again, going back to what I was saying about forecast models and just knowing your numbers inside out, there is that really, really important element of can my business afford to take this on? Can I work these payments through? Because I mean, that's just it seems obvious, but a big facet to talk about in terms of debt versus equity. But yeah, Sam, do you want to chat through kind of some of the counter elements there?
Yeah, I don't think there's no right or wrong. This is very specific to individual companies, as you've mentioned. Equities, quite often you will use both at the same time as well. You can use some debt, some equity, along with. I know you're going to cover grants and R&D as well in a minute, but it's kind of you pick the most appropriate or a combination that are best fit for you. I mean, equity is you can raise a huge amount. Usually, would tranche it over funding rounds. So you'd raise 250 in your first round, 1 million in your second, and da 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 da. And you can look at how that works with companies like I don't know. WeWork's a bad example, probably given their financial challenges, but they are a really good example. They went from very modest funding rounds all the way up to tens of billions, and you can step up like that, and the capital tends to grow with you. Um, I guess, debt is you're borrowing against something, whether it's predictable cash flow or an asset or invoices or whatever. Quite often, equity can be used when you don't have traction yet. So if you're pre-seed, pre-revenue, you haven't launched a product, then equity works, whereas debt sometimes doesn't. One thing that affected me as an individual, so I bootstrapped to 30 million in 4 years, so I didn't take debt or equity. I tried taking a little bit of debt, And I was told you need to risk your house. That was from NatWest, which is a traditional lender. And they're like, yeah, you're going to need to give a personal guarantee and risk your house. At which point I'm like, sod it, I'll put 50 grand in myself. But yeah, that was a little bit awkward. I know not all lenders are like that. But I didn't want to dilute, as Kieran said, I didn't want to, dilute my company at all. I also didn't want to risk my house. So there isn't always a great fit. And I guess the other thing that equity does, you can quite often people get what's called smart capital, which is where somebody not only puts £50,000 into your business, but they can help you. They're a NED or an advisor, or they can make introductions that, into places you couldn't otherwise access. And I think that again is a superpower. That's really, really, really important for lots of businesses. But it's horses for courses.
Super. I just see we have a hand raised there. So I don't know, Daniel, did you have a question? I just invited you in. If you did, please fire away. Oh, I see you popped in the chat as well. What are the funding options for limited companies whose directors have bad credit? Yeah, that's a really good question. I think the first thing to say is that there are funding options out there for businesses that have bad credit. So I think all all lenders and I suppose the equity funds will have kind of this information available to them. So it's no bad thing just to be aware. If you're not aware of what your personal or your business credit score are, you can go to websites like Experian or Credit Safe or Equifax to find that information out. Minor plug, but if you go to Swoop and put your company's house details in there, we'll also show you what your business credit score is there, completely free. But it's important just to be aware. It's not means you won't have options. What it does mean is it will limit your options. So a lot of the kind of main high street banks won't in some cases, but there are alternative lenders that will provide capital to businesses that maybe have CCJs, or in some cases, I've seen it where business owners weren't aware that they had a CCJ, and they can clear that off, which in turn improves the credit. The other element as well, and a way to kind of improve it and improve the credit score is you have kind of credit building tools. So you'll have maybe credit card companies, people like Capital and Tap that will have kind of low credit products that allow you to kind of repay small amounts on a month by month basis. Now, it may not solve your immediate credit need. You might need a larger sum of financing, but by utilizing these small credit products, it starts to really improve your overall credit score. Therefore, in the not too distant future, giving you kind of a wider pool of options. But I think the most important thing is just to be aware, go onto those different sites so that you know those scores, and then you can find institutions and lenders that will provide credit. And obviously, it won't be as well priced as say the high street bank. Super. Okay. Thanks for that. Keep the questions coming. Uh, so wanted to kind of move on now and just talk about another option when it comes to funding. Again, speaking personally at Swoop, we have taken in just over 8 million in grant funding. And the big plus with that is it's non-dilutive. So the money doesn't need to be paid back in interest, nor do you need to give away a percentage of your business. But with grant funding, it needs to solve the need of whoever the bursar of is. Often the bursar of the grant can be government orientated. So for them, it's aligning with their overall strategy, which is often to increase employment in certain parts of the country or increase innovation and production in certain key sectors they see as core to the overall country's strategy. Outside of that, it's also good to see what private industry might have with regards to grants. One that often businesses overlook that are actually relatively easy to obtain are some of the big businesses like your Amazon, your Google, your Microsoft, whereby lots of businesses these days have big websites, have to spend a lot on data and hosting. Most of those big organizations that I mentioned will have programs where you can get a lot of your early expenditure in that area covered. So, for instance, with Swoop, with Microsoft Azure, we had our first $250,000 of hosting completely covered for free. So, again, just be aware of these schemes. However, if we think of like traditional grants and how you can think or analyze yourself as a business, whether you're grant worthy or not, most traditional grant agencies will classify businesses along the technology readiness scale, the TRL scale, which kind of strands from 1 to 9. Typically what you'll see is the vast majority of grants are geared towards businesses that are thinking about projects that are in the TRL range of 4 to 8. So you've kind of gone out yourself, done research, felt that there's an opportunity to develop and innovate in a certain area. But what you're using the grant-based funding is starting to go out and build and create a prototype, an MVP, and getting into the early onsets of testing that and showing product market fit with a view to fully commercializing it. And so the vast majority of grants will be orientated in that TRL 4 to 8 range. So as you start to think through projects that you're thinking about doing, it's really, really important, first of all, to see is there grants there that can help you because they can be the cheapest form of funding. But one of the kind of the ways to think about it is like what's available in my sector, what's available in my region, because often that's how grants are orientated. But having a good awareness of what's out there could be something that could growth hack your business and save you a lot of money, whether that's equity given away in the business or debt to be repaid back. So from a personal experience, I definitely strongly encourage business owners to think about this. Innovate UK is probably the biggest custodian of grants within the UK. So always worthwhile having a look at that. I know it's not a grant per se, but they've been super aggressive in giving a lot of funding out to the Innovate UK loan scheme. We've seen that open for applications again and again and again over the last year, and they're increasing the amount that they're giving out there. Reason I mentioned it is it's a relatively open scheme, and the rates are super attractive. It's a 3.7% interest only Innovate UK loan for, of course, the first 3 years before the capital payments come in for the latter 3 years. So definitely something to take a look at, and because it's super well priced relative to what else is on the market. So definitely something to look at on the Innovate UK website. Um, and then just wanted to touch on the R&D tax credit scheme. I know a lot of people will have heard of this, so I won't go into too much detail. But essentially, if you are innovating, i.e., you're investing in new technology, investing in new processes, and particularly if you're carrying out that activity in the United Kingdom, whether that's through freelancers you're using in the United Kingdom or employees that you're hiring in the United Kingdom, you absolutely should be looking at your R&D tax credit eligibility. And if you're loss making business, that means that could be cash back into your business. Again, personally speaking, this gets hundreds and thousands of pounds back into our business down through the years. And then as you transition to a profitable business, this can be taken off your corporate tax bill. And there's been various different changes to the scheme, and certainly HMRC are a lot stricter on it. But I mean, as long as you're following the rules and you are doing innovating, absolutely you should be looking at that. But they've also improved areas of the scheme. So things like your expenditure on software tools or hosting, a lot of that can be 100% covered within in the R&D tax credit scheme. So absolutely strongly encourage anyone that's in technology, engineering, manufacturing, science to be analyzing their business, their employees that are within that, and seeing if they're eligible for that scheme, because it can be a great way to get cash in or reduce corporation tax bills. Um, so obviously we'll move on to the Q&A side of things, but just to quickly wrap up in terms of what Swoop and Founder Catalyst to do, but then very keen to jump into questions. From a Swoop perspective, we have a platform for any business owner to come on and just sense check eligibility, to the previous question, you can see your credit score, so you can see how lenders can view you, and then you can look at all different funding opportunities that you are eligible for. And should you be interested, you can then use the platform to be able to access them. And then Sam, do you want to give an overview on Founder Catalyst?
Yep, for sure. I think I plugged earlier, but I'll plug again. Why not? Yeah, so I mean, Founder Catalyst broadly offers two sets of services. We help you incentivize employees, advisors, NEDs, and chairmen and similar via EMI and unapproved option schemes. That's product's been going for about a year, and yeah, is very, very popular for people that have achieved funding via either debt or equity, actually. The second thing we do, and our primary service is around funding rounds. We help people get SEIS, EIS advance assurance. We help people close funding rounds, so we produce every legal document you need to go through that process. We've got a data room and cap table management and online signing. And then we help you manage the quirky post-investment paperwork you need to issue to HMRC and then your investors as well. I guess just to finish off, two things that make us unique. We're commercially unique, so everything we do within a funding round is a fixed fee of 1.5k plus VAT. And to give you an example, one of our customers raised 2.8 million quid using us, and our fee was 1.5k plus VAT. The next most cost-effective way of somebody doing that would have been £15,000, so 10 times the amount. And secondly, you get to deal with real humans like me who are exited founders and angel investors. So every founder who uses our service gets direct access to us, which is really useful if you want to pick our brains on what will an investor think of this, or as a founder, what should I think of that? I think I'm on my sixth or seventh business, so I've been around the block, and I love supporting founders. Enough of me, though. Should we, if everybody wants to start throwing some Q&A into the chat, that would be amazing.
Yeah.
And we will get through
Yeah.
those.
Super. Yeah, we've got a great one in here just now from Lee. So Lee has done something very, very impressive. He's built a battery that can power a mobile phone for 5 years without recharging, which is truly remarkable. He's in the kind of TRL 4 to 6, kind of working through the prototype, but hasn't experienced in terms of finding angels or accessing grants based in Manchester. Sam, do you want to maybe chat through kind of some thinking around angels, and then maybe I can flip over on the grant side.
Yeah, for sure. So congrats on your on your idea. Apple will acquire you within 5 minutes, I'm sure, when you manage to launch. But it's interesting. Battery technology is right on the cusp of an excluded trade. Broadly, there's a bunch of excluded trades around, producing electricity and based upon what you've said, then I think you will be allowable under SEIS. But HMRC will almost certainly query your application. But yeah, so congrats on that. In terms of, there's a few steps you need to go through. You need to get your ducks in a row, as I mentioned earlier. That's a relatively straightforward process we can help with. We also help founders to understand where to meet angel investors. So, for example, we've got an interactive map of all 100 angel groups within the UK. We've got FCA regulated platforms we can get you on that get you in front of tens of thousands of angel investors. We can point you towards angel groups that are very specific to your niche, whatever that happens to be. There'll be somewhere out there, and there are also amazing search engines like shipshape.vc, for example, that allows you to type in, no matter how niche your business, it will try and find investors that are a good fit. And there's Scribe Labs as well that finds angels specifically interested in your kind of business type and then allows you to do outreach. There's lots of ways we can support or at least point you in the right direction. So let's have a chat, Lee.
Yeah, just to tag on there, I would say, like Sam said, there's loads of angel groups out there. I know there's a platform called Angel Investment Network, which has a pretty healthy
Mm.
access to angels on it. I think one thing also just to think about, and I think there's probably templates on Founder Catalyst website and Swoop's website as well, is just thinking about your pitch deck. So obviously before going to the angel, and Sam's talked a lot about being investor ready with regards to having SEIS, but one other thing you probably want to think through is just how you present the business. So how you structure the business opportunity before going to an angel. So one thing you might want to think about, Lee, is that pitch deck and how you structure the proposition. So I'd recommend having a look a couple of templates there before kind of engaging on the angel side of things. And again, from a grants perspective, little plug-in from the Swoop side of things, but you please use our platform to search against opportunities that might be within the Manchester region. Again, I'm very happy to follow up over email afterwards and kind of connect you in to a few different grants or grant writers that you might think might help you as well as you potentially explore that path as well. So next question up is from Bala, who's a Founder Catalyst customer. He is trying to raise from angels in the US, UK, and India. And his question is, can they use a safe for US investors, or do they have to have the same structure for everyone?
That's a really good question. So, safes are never seen in the UK, for UK investors at least, because they are not SEIS compatible. So, the only three ways you can close a funding round in the UK are a price round, an agile round, and something called an ASA, which I personally despise, but that's for another day. Yeah, those are the only three ways. You never see convertible loan notes, safes, options, or warrants because they're just not compatible with SEIS. However, if you're doing a cross-border transaction, you may be able to use something like a safe in the from US investors and couple that with another instrument, one of the other three that is SEIS compatible. So broadly, you can do that. The challenge being that safes stack in a really unpleasant way, and your angel investors may, they may spot that and not like having a very, very different instrument to the one they're using in the mix. But yeah, I mean, there are ways and means, and we have got people that have raised a mixture of convertible loan notes from abroad, safes from abroad, and a price round. It can happen, but just watch overcomplicating things. I think there's a good motto in everything in life, but in fundraising specifically around keeping things simple.
Super. So next question up from Carl. It's around EIS timing.
Oh,
So if a company received advance assurance and completed an EIS investment in 2021, does that insurance assurance apply to that specific investment? And I
yeah.
think it's two parts. And for a new raise in 2026, would the company need fresh advance assurance, particularly where the business began trading earlier with the new raises for growth and innovation?
I mean, broadly, you don't need advance assurance at all. It's a comfort blanket for investors. You can do a funding round without any SEIS advance assurance and then hope for the best. I'm saying you can. Your investors will probably refuse that because they will want the comfort blanket that is advance assurance. Advance assurance itself doesn't expire as long as the business remains compatible with the scheme. You don't need to refresh it. That said, as an angel investor, I would absolutely force you to update that advance assurance. I think it's 5 years old. There have been a few tweaks to the legislation in the time, and I don't know how close you are to the 7 year limit. I don't know whether you can make use of EIS Condition A. There are lots of questions, and Carol, I'm going to put my contact details and we can have a chat. But long story short, I would, as an investor, I'd probably be asking for a new, fresh advance assurance just to get comfort. And therefore, there's no reason why you shouldn't apply for that now and get ahead of that question. The nightmare scenario is you find an investor, they're interested, and then they force you to do the advance assurance, and that can delay you up to a month, which would be very frustrating.
Super. Okay, next one's for me. Does Swoop allocate one person to the business to look at what support is required? I had reached out to Swoop and I had 4 to 5 people reply back for different products, and it was very overwhelming. After I responded to one person, I met them and wasn't able to help. This was a year ago. We're now looking to grow, working in R&D with Innovate UK. The support we need is one point of contact and can hear where we are at the business and work with us to gain suitable options. Yeah, absolutely. I think probably one of our challenges is when a business connects. There's obviously different angles we can go on. But if you're very focused in on R&D and grants, I absolutely can follow up Mary and just give you one grant point of contact to work with. That's very doable. I will sort that out. Okay. Next up, yeah, Phil I was chatting to you this morning. We've got we at Reina have developed some neat software for helping SMEs grow, scale, and model growth levers and forecast valuations. Yes, very, very cool tool. I saw it this morning. Would this align with Innovate UK grants as it helps support SME growth, employment, tech enablement, and investment? I think, and again, I obviously I am not the oracle for Innovate UK, Phil, but where I think you may struggle on the grant side of things is the underlying technology that you're creating in order to run your tools to give businesses better insights in terms of how to forecast. The technology isn't new per se, so you're not creating something. The application is obviously great and it really helps businesses, but with grant funding, what a lot of the grant agencies or bodies, particularly Innovate UK, is they're trying to push the custodians of the new technology, the new process, the new science in a way that it's not been done before. So based on kind of how the tool is currently set out at the moment, the underlying technology you're using is stuff that is out there at the moment. So I don't believe in its current guise that it would be a good fit for an Innovate UK loan. So Daniel is up next. I own our Sky Media, and we're drone-based surveying, mapping, and videography, and a really bad credit history. I'm struggling to find funding. I'm based in East Midlands and don't know where to turn. So I think maybe something practical on this, Daniel, is when I circulate. Well, we did this last time. We circulated all the cute questions and answers. I can send this to you both directly, but I will list out a series of different providers that will look at people with poor credit history. So hopefully some of those names that I do list aren't ones that you may have not been able to turn to just yet. Failing that, I will show also in that same answer, show some credit building tools. So for instance, I'm not sure if people might cross a challenger bank called Zempler, but one of the things, as well as getting a bank account with Zempler, they allow people to build up their credit score by paying micro payments on a monthly basis back, which in turn bolsters your credit score quite a bit, which then in turn gives you more optionality. So that's something you might want to look at. It's Zempler, and it's a specific kind of credit builder tool to help people with bad credit to then be able to go and get access to funding. So I think Carol's got a follow-up question for you, Sam. Uh, for early stage businesses working on product and materials innovation, any impressions on how are investors currently thinking about new innovation risk, particularly where R&D, sustainability, and manufacturing readiness overlaps? You're on mute.
Apologies, my internet died and I had to rejoin. I assumed I'd get away with it, but damn it. Sorry, there was a question just before on credit. If you've got a bad credit, how do you get funding? Lots of angel investors won't look at the founders of a business and their credit scores. So I'm not saying you'd be doing anything disingenuous. It's just, lenders always do, don't they? They're very good at doing
Yep.
DD on lenders. Angel investors typically won't. So I'm not saying you lie about it or be disingenuous, but if you're not asked, you don't tell. As an angel, I wouldn't expect you to give me that information unless I ask. So, on Carol's point, so I'm an investor in a new materials company myself. There's a company called Kelp Industries or Kelpie out of Bristol, which makes biodegradable plastics out of seaweed. I love it. I found a catalyst, supported them as a customer. I fell in love with the company so much that I invested. There is appetite out there for it. They have many millions in funding now. I invested at SEIS level, but yeah, they've got many millions in funding. So it is one of those areas, every investor wants traction. They ideally want you to have a product and be selling, but materials is one of those interesting areas where people do tend to have a punt. So yeah, I don't know exactly what your business does, but hopefully that gives you some comfort that there are investors out there.
I think the next one's probably a straightforward one. Jared's got his first project up and running, and would we be open to taking a quick look at his pitch deck and sharing any feedback? Yeah, absolutely. Jared can share your details. I'm
Send it to us
sure
both.
Sam
Yeah,
would
we'll
be
both take
happy.
a look.
Yeah, yeah, super. And then some very kind person, oh, sorry, not I can tell. It's anonymous at the top. It's from Jeff. He said, thanks for the webinar, clear, helpful, and jargon free. So, yeah, we will continue to try and do as many of these as we can.
Thanks, Dad. Really appreciate the kind message. I'm kidding. My dad's not Jeff.
And then Chris is one here. We've just registered as a limited company and considering equity investment. There are two of us working in the business. We're not paying salaries to either of us. This does not accurately reflect the financial viability of the business. How does this look to investors? Is there a way I should show this?
Uh, no, that's really, really standard. So it's called sweat equity. You're going to sweat literally for the until you take on funding. That is really standard. You don't need to do anything special. Investors, this is the default. Yeah, investors won't be surprised at all. When you come to close it, the more challenging conversation is when you come to close the funding round. You then need to get off the fence and decide how much you're going to pay yourself. Now, you may decide nothing, and that's okay. You may decide, if you're raising 250 and you want to pay yourself 250,000 a year, that's not going to go down so well. But if you're raising 250 and you want to pay yourself 30,000, then most investors will say, the dude's got to live. So I think, yeah, as long as you're reasonable and transparent, there's no drama. It's just very expected, Chris. So yeah, don't panic. Did we get through all the questions? I think last time we overran by half an hour, didn't we? I think, or something ridiculous.
Yeah, yeah. I think seem to kind of gotten through nearly all of them. I'm also conscious of the time, but I think
Sure.
like what we did the last time, we will wrap all the Q&A together, send that out in the email that we send to everyone afterwards, which has the recording, but also the Q&As. Should have our details in there as well. So if is anything that we didn't cover today, just let us know. As I said, we really enjoyed doing this, particularly the Ask Me Anything aspect to it. So hopefully people find it useful, and no doubt we'll be back doing it again not too soon. But thanks everyone for logging in and sharing so many questions with us.
Yeah, thanks all, and thanks to you, Kieran, for hosting.
Thanks, Sam. Thank you very much. Cheers, guys. Hope everyone has a lovely weekend.